Microsoft stock is down 24% this year. That is not a typo. The company posted $81 billion in quarterly revenue, 39% cloud growth, and a demand backlog larger than the GDP of most countries. The market looked at those numbers and sold. That gap is where this story begins. Azure's commercial backlog hit $625 billion in the second quarter of fiscal 2026, a 110% increase year over year. Satya Nadella called it proof that Microsoft had built an AI business larger than some of its biggest franchises. Analysts upgraded. Headlines celebrated. Then the stock dropped anyway. The reason was buried inside the fine print. Microsoft's CFO, Amy Hood, disclosed on the earnings call that a single customer accounts for roughly 45% of that $625 billion backlog. That customer is OpenAI. Microsoft invested $13 billion in OpenAI over 6 years. OpenAI then committed $250 billion in cloud spending back to Microsoft's Azure under the renegotiated October 2025 deal. Microsoft books that commitment as contracted future revenue. The company that provided the funding is now counting the spending of that funded entity as independent demand growth. The same dollar moved in one direction. It was recorded twice. If you like what you're seeing, subscribe. This is the kind of story most channels won't touch. That structure deserves a closer look because OpenAI is not a stable counterparty. In 2025, the company generated $13.1 billion in revenue, the fastest revenue growth of any enterprise software company in history. It also burned through cash faster than the revenue grew. Internal projections reported by the information show OpenAI expects to burn $25 billion in cash in 2026 and $57 billion in 2027. Cumulative cash burn through 2030 is projected at $665 billion, a figure revised up by $111 billion. Earlier estimates, driven by inference costs that quadrupled in 2025 and gross margins that fell to 33% against a 46% target. HSBC analysts estimated OpenAI faces a $207 billion funding shortfall through its own growth plan. Microsoft's largest customer has never been profitable. It spends roughly $2 in compute for every dollar it earns on inference. It is committed to $250 billion in Azure spending, a commitment made by an entity that will need hundreds of billions in outside capital just to stay operational through the decade. That was not an independent demand signal. That was a financing structure calling itself demand. In Q1 of fiscal 2026, Microsoft reported a $3.1 billion equity method investment loss from its OpenAI stake. Net income still grew, the headline was fine, but the $13 billion bet on OpenAI was in that quarter subtracting from earnings. Then in Q2, the opposite. A $7.6 billion gain from the OpenAI recapitalization inflated GAAP net income by 60%. Non-GAAP earnings, which strip out the OpenAI effect entirely, showed 24% growth. Both versions are technically accurate. Neither tells the complete story. The P&L now moves with OpenAI's valuation events. That is not the same as independent operating leverage. Microsoft's capital expenditure in the second quarter was $37.5 billion, up 66% year over year. Full year 2026 CapEx guidance came in at $190 billion, blowing past Wall Street's $154 billion estimate by $35 billion. The company has built over 400 data centers. It added more compute capacity in 2025 than in any prior year in its history. Morgan Stanley's head of software research said on the earnings call, "CapEx is growing faster than expected, and Azure growth is coming in a little slower than expected. That gap, CapEx up 66%, Azure up 39%, is the equation the market is pricing. There is also $80 billion in Azure orders Microsoft cannot fulfill, not because demand is weak, because it cannot find enough electricity to power the data centers it is already building. Microsoft is spending $190 billion to serve a backlog 45% owned by a cash-burning startup, while leaving $80 billion in orders unserved due to power constraints, while its own stock falls faster than at any point since 2008. Then on June 3, 2026, today, Microsoft held its annual Build Developer Conference and announced 7 in-house AI models under the MAI family. My Thinking 1 matches Claude Opus on software engineering benchmarks. My Code 1 Flash uses 60% fewer tokens than Claude Haiku on coding tasks, is being integrated directly into GitHub Copilot. Both were trained on clean, commercially licensed data, with no distillation from any OpenAI model. Mustafa Suleyman, Microsoft's AI chief, described the company's goal as true self-sufficiency. In enterprise tests tuned for McKinsey, the MAI models outperformed GPT-5.5 at claimed 10 times better cost efficiency. Microsoft just publicly out-benchmarked the company it spent $13 billion building. The partnership was already loosening before today. The October 2025 restructuring removed Microsoft's exclusive cloud distribution rights. OpenAI can now route workloads to Amazon Web Services, Google Cloud, or its own infrastructure. A deal renegotiated in 2026 caps the total revenue Microsoft can ever collect from OpenAI at $38 billion, down from an uncapped structure that could have reached $135 billion. OpenAI saved an estimated $97 billion through that cap. The ceiling on what Microsoft can collect was set by the entity most motivated to reduce what it owes. If you're finding this useful, subscribe now. The next video in this series goes deeper. OpenAI is also building its own hardware. In October 2025, it announced a multi-year collaboration with Broadcom to design and deploy 10 gigawatts of custom AI accelerators, with deployment beginning in the second half of 2026. The purpose of that infrastructure is to run OpenAI's workloads independently of any third-party cloud. In May 2026, it was reported that Broadcom would not finance production unless Microsoft agreed to purchase 40% of the chips. An OpenAI manager called the dependency financially unattractive. OpenAI's path to leaving Azure requires Microsoft's cooperation. That dependency is real. But the direction of travel is not ambiguous. The company that owes Microsoft $250 billion is building the hardware to stop needing it. None of this would register as a systemic concern if Microsoft were an obscure mid-cap. It is not. At its 2025 peak, Microsoft was among the 3 most valuable companies on Earth. It is one of the 5 largest holdings in essentially every S&P 500 index fund, total market ETF, and target date retirement fund available to American workers. The top 5 companies in the S&P 500 now account for 30% of the entire index. That is the highest concentration in more than half a century, higher than the dot-com peak when the top 10 companies held 27%. A teacher with a 403(d), a nurse with a target date fund, a warehouse worker whose employer-sponsored retirement plan defaults to a broad index. None of them selected Microsoft. None of them know what Azure's remaining performance obligations are. All of them are exposed to what happens next. Microsoft also froze hiring across its cloud and sales units in March 2026. That freeze arrived at the same moment CapEx hit nearly $37, $5 billion in a single quarter. The workers most affected by that decision were not in AI research. They were in the operational layer that was supposed to convert AI investment into sales. The infrastructure build is accelerating. The headcount that sells and deploys it is contracting. There is a precedent for this structure. In 1999, Cisco Systems was briefly the most valuable company in the world. Its routers and switches carried the internet. Every telecom company, every enterprise, every startup building for the web needed Cisco equipment. The stock had surged roughly 1,000% in a decade. Cisco was the indispensable infrastructure layer of the digital build-out, just as Microsoft is the indispensable infrastructure layer of the AI build-out. Cisco's customers were also spending heavily, financed in part by vendor credit arrangements that the industry called normal and analysts called growth. When the build-out cycle normalized, enterprise CapEx contracted. Cisco's revenue assumptions proved wrong. The stock lost 88% of its value by 2002. It took 25 years to recover its inflation-adjusted peak. The comparison is not exact. Microsoft is far more profitable than Cisco was at its peak. Cisco traded at 200 times earnings at the height of the bubble. Microsoft is not in that territory. The structural question is not valuation froth. It is something more specific. Whether the infrastructure king of a build-out cycle, after absorbing maximum capital, faces maximum exposure when the cycle turns, and whether the company that looks most like a winner is actually holding the most concentrated bet on the cycle's continuation. There is a version of events where all of this resolves cleanly. OpenAI reaches profitability on its projected 2029 timeline. Azure demand diversifies beyond OpenAI. The MAI models generate independent enterprise revenue that replaces API dependency. If $190 billion in CapEx produces the returns the forecasts assume, that version is possible. The market is also pricing a version where it does not. Where OpenAI's cash burn continues to exceed projections, where the $250 billion Azure commitment becomes uncertain, where the $281 billion of RPO tied to a single unprofitable startup is worth less than it appears on the balance sheet. The market held that concern through a record earnings beat and sold the stock anyway. Not every dollar of AI infrastructure spending will prove to be real demand. Some portion of what looks like a demand signal is a financing structure in motion. Money invested, money committed, money booked, money recounted. Dot-com crash did not kill the internet. It killed the assumption that every fiber optic cable laid in 1999 represented a paying customer. The Nasdaq fell 78% and took 15 years to recover. E-commerce, search, and digital advertising survived and eventually generated more value than the bubble had ever priced. The same separation is available now. AI will survive whatever comes next. The code generation is real, the latency improvements are real, the enterprise productivity gains are real. What may not survive is the specific story that the company which financed the AI boom could also be its dominant infrastructure winner, its primary model supplier, and the senior shareholder in the company it is now competing against, all simultaneously with the same counterparty for the same dollars. If this video added something real, subscribe. Every video in this channel runs on the same standard. Verified facts, no hype, no filler. Microsoft spent $13 billion making OpenAI indispensable. Today it announced the models to make OpenAI optional. The question is whether the $625 billion backlog survives the answer.